Okay, so moving average, convergence, divergence, the MACD, is basically computed through most of the algorithm we're told about. Actually, some of it's copyright protected and all that good stuff to where the average Joe's not allowed to know about it. But the basics of it are really simple. It's a comparison between the convergence points and divergence points of two exponential moving averages in comparison with volume and a directional average. What that really means is it's not simple like a simple moving average. You basically get your directional crosses not just based on the movement of the stock, but also how volume correlates into it and how the stock price reacts to the volume. Meaning, a lot of times if you're going down on a very low volume pullback, you'll start to get a buy signal from your MACD, even though the price might still go lower. Perfect example of that, I've got a MACD. This is just the standard average setting that's defaulted on most charting software, 12, 26, 9. You see that the cross happened here on 218 on a daily chart. Okay, so now I'm going to come here and we'll go to 218. And if I was trading my MACD, I would have bought this on the cross at that close, so 86.74. And a lot of times when you use like the MACD specifically, have you guys ever looked at your indicators and said, I don't know why the price is going down. My indicator still says buy. Has that ever been you before? It's been me. I'm not going to lie. When I first started trading, I'm like, okay, I read everything about how to trade these indicators and okay, I bought because it crossed and that's my price isn't going up. It's because there's some external factors. And remember too, the markets are like purposely designed to hurt any short-term trading. So even though that cross could still possibly lead to a profiting trade, it doesn't necessarily have to. But it doesn't necessarily have to be the day after you bought it. It doesn't have to say it cannot go lower. And basically, when you look at those differences on that MACD setting, that 12, 26, 9, what it essentially is this purple line that I have on my chart. Everybody see the purple line? That is commonly referred to for your MACD as your signal or your standard. And it's the third number in that setting. So the 12, 26, 9 means my purple line here, I set it as purple, it doesn't default as purple, is a 9 exponential moving average. So if it's the MACD basically shows me some symbolism between the convergence points, the points that they come together, and the divergence points, the points in which they move apart. What exponential moving average is my blue one? It's a 14. And actually, I had those backwards. The purple one is the 14, the blue one's the 9. Do you know why it's a 14? A trend following momentum indicator that shows the relationship between two moving averages of prices. The MACD is calculated by subtracting the 26-day exponential moving average from the 12-day exponential moving average in comparison to a 9-day exponential moving average of the MACD, also called the signal line. It's the difference between the 26 and the 12. Okay, so we all there? Everybody kind of on the same page with me? On why the purple one actually, like I said, I'm mistaken. Those of you watching the video later, the purple one's the 14, the blue one's the 9. So basically, what that's kind of telling me is that if I came into my studies and used exponential moving averages of 9 to match the blue one and 14 to match that purple one, that you would think with the definition of the MACD that I just read, that these would correlate extremely well to each other. Well, my MACD said to buy on the 18th at 86.74. Did my exponential moving averages on my chart also tell me the same thing? You know, I started this by asking you if you'd ever bought something because an indicator curled up. It's like, okay, the MACD's been getting beat all to heck. It's curling up, man. It's actually, the cross is still there, right? It's actually still saying buy, right? If I was trading based on the MACD, this thing is just screaming buy, 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 right? But you see, there's other factors in what calculates that MACD. Those other factors, of course, like I said, being volume and a reaction to price at volume points. Meaning, if you get a big spike in volume and the price goes down, you might get a downwards cross. If you get a big spike in volume, the price goes up, you get an upwards cross. If your volume is tapering off, but you're continuing to fall, it actually will have very little effect on the indicator, and it will actually give a false signal in the sense of, not necessarily a false signal in the sense of it can't result in a winning trade, but a false signal in the sense of it told you to buy and the price still went down. Yet what I found with the MACD in general is because of the added factors. Okay, it sounds like a good idea. Hey, I buy when this thing crosses, the blue line crosses that purple line. Okay, that's what I buy. Sounds like a great idea. But in reality, that's not taking into account that a low volume pullback might just be more room for it to go up. I'm just not going to necessarily get that low of a price. And if I hold it long enough, I could very likely have a winner. But what that MACD doesn't take into an account is that low volume pullback or not, I really don't want to intentionally enter something and see it go down. Do you? I mean, I do enter things and they do go down, but I don't want part of a trading system that I might follow to say, you buy here and you just hope eventually it comes back, because as long as that's over there, let's just go. Let's hope it works good. We don't really want that. In a perfect world, anything we bought would go up from the price we bought it at, right? Unless, well, not unless anything. If we were going to use a trading system, if we were going to base any type of trade entry on something that actually could cause us to just buy and hope it goes good, how could that really have an effect on us? Let's think about it in the terms of stuff we trade. We trade a lot of options here, right? Trade a lot of options. So I have time to wait for this to go up. Can I just suck it up and wait? And sometimes in any type of trade, you might be stuck in a position where you have to, but do you want to use a trading system that deliberately tells you, hey, you just got to suck it up and wait? And what you'll find a lot of times is these indicators, because there's other factors other than just price that are factored into them, into their algorithms, that they will actually do this to you many times. That's why I love, like, when people reference like a stochastics and use the terms like overbought and oversold. If we're using that, well, use standard stochastic settings on the S&P 500. It's been overbought for 3.5 years now. Most good stocks that have a chance of making you money are going to be overbought because they're worth buying. Most bad stocks that are oversold for a reason. And then there comes the other bad part about the indicator itself. Do you know the funny thing is if I took a screenshot of this indicator exactly as it is right now, in a year from now, compared it to the exact same days on the chart, it would be different? Did you know that? All of your standard indicators, a MACD, a stochastics, an RSI, a CCI, any of that kind of stuff. You see, right now in this very instant, it might tell you one thing, but if you look back at it in 6 months on the exact same day that it told you to do something, it might not be telling you that anymore. There's actually refactoring and longevity averaging that goes into when you try to like backtest the chart. So one of the worst things you can do if you're trying to backtest something like with indicators to see if, hey, let me see if my MACD would work on this chart. What you're ironically going to find is it'll almost always work when you're looking back in the past because of how the refactoring works. If you're going to try to test and study something, you almost have to do it in real time. Meaning, okay, it said gave me the signal here, so let's go from this point on and take notes on it and follow it. Because many, many times when you go back and look, those indicators will change just slightly. And I'm sure people that have traded for a while might have noticed that before. Like, hold on a second, I thought yesterday it said my RSI was 52. Today it's 48, but it says it was 48 yesterday, and it wasn't 48 yesterday, it was 52 yesterday. You ever seen that or noticed that before? Maybe I just pay more attention than others. So when you look at the ease of trading like a MACD and then compare it to what actually matters to you, and what actually probably matters to you is the price of something, right? If I buy stock long, I want stock go up, right? I swear sometimes I'm the only person here. Well, simply basically picking out from that MACD the two items that would be the most essential to you as an individual trader, which would be the moving average aspect of it, the one correlated only with the price. I have found to give much more effective trading signals than by using the actual indicator, which makes factors other than price part of its computing algorithm. Okay, so what does that mean? That means that my recommendation would be, if you'd like to use the MACD, then use it like this. Does anybody see the difference here? What you'll actually find when you look at the difference is that the good trades that the MACD gives you, this one still gives you. And the trades like where the MACD crossed on February 18th and told you to buy, this one didn't give you, did it? Now for me, I've tailored this and tweaked it even more to where I have found an even better sense of finding myself trades that is more, that has more ability to be transcribed to any time frame chart. This type setting with exponential moving averages of 9 and 14 would correlate to your standard 12, 26, 9. What's another value or program settings that people commonly use for a MACD? Probably most of anybody in here that uses a MACD probably doesn't use a 12, 26, 9. They use what? Usually people use a 613.5 if they don't use a 1226.9. And why would I make that assumption for people in here that would use a 613.5 instead of a 1226.9? Because most people in here came from like a penny stock trading service, and not just that one penny stock trading services, but most that trade using a MACD and that particular type of trading have a standard of using the 613.5. What would my two exponential moving average values be with a 613.5 MACD? There we go, a 5 and a 7. If you're using a 613.5 and wanted to correlate that into just the exponential moving averages for your own personal trading, like on a chart without having to factor in algorithmically the volume and the other aspects that a MACD does, you could simply use a 5 and a 7. Now, let's think about what would give you your buy and sell signals. What gives you your buy and sell signal with a MACD? What gives you the buy signal for starters? And some might say green line crosses red line, crosses above red line. Well, in this case, the blue line would be like the green line. The purple line would be like the red line. So, though not perfect, Alibaba would have told you to buy here. It would have told you to sell here. It actually would have told you to buy here and sell just a couple days later for a loss. And here it would have given you a loser as well. Do those two losers add up in comparison to the size of the winner, for one? Not to me. Two losers were, that one was a decent one. The other one was just, about a buck. But it was also made up. That's where it's messed up. I thought it looked a little weird and it was messing me up. You still would have had the same crosses. But the reaction on the cross below was a little better. And you got the cross below earlier here than you did here. And if you look at this cross above here, here's the cool thing. This would have also given you winning trade here, winning short because it crossed here. It gave you the buy down in here. And also, let's see, another nice winning short here that still didn't cross until here. And even this day here, obviously another winning short trade, right? Everybody see that? I don't know why I changed that to 9. I still messed that up. Had a busy day. There we go. Very close in reaction, but with the ability to still, and actually a much better reaction over here. Now, if you look at that with Alibaba per se for like the 1 hour chart, again, what you find is times like right here when it crosses and then crosses back below here are actually fairly small and minimal losses. But in perspective to comparing it to like just an 8 simple moving average, what do you see about something like this that gives you buy and sell signals maybe a little bit earlier? The quicker reaction of the 5 SMA, right? Well, one thing that I had found with my MACD in general and even a few other things, and this is where I got the 9 from when I said I messed up, is that a MACD setting of 6, 15, 5 actually is going to give you a little more consistency. That's where the 9 comes from, because 15 minus 6 is what? And though the 6-13-5 MACD setting would probably be the most consistent on the daily chart only, when you correlate it to multiple time frames of charts, a 6-15-5, which would give me EMAs of 5 and 9, actually gives a lot more stability, not only in a confirmation on your buy signal, but a quicker reaction on your sell signal than maybe simply just using a single moving average. You ever notice, like with an 8 moving average, it definitely doesn't give you the lowest possible buy price. And the only time it really gives you a good trade is when it really gets a nice move, because if it's just kind of a subtle move that, yeah, there was profit, but by the time it curled down, now I'm kind of breaking even. Has anybody ever noticed that? And I've long said that about the 8 SMA. The 8 SMA is great for the short-term moves because if you trade it properly, you'll be in for all of the big moves. And on the ones that don't move very big, plus or minus just a little bit, you're basically at a break even. When you add that correlation with the exponential moving averages and basically what I'd say is programmable MACD numbers, you're going to find the ability to trade them like it's actually a MACD. So in this particular case, what would indicate for us to go long on BABA? What indication would we be looking for to go long on BABA using MACD moving averages? There we go. The blue line to cross above the purple. So basically, if I'm looking at my 60-minute chart here and I come back here and, okay, got a couple green candles. And right here, would you say that's giving me a buy signal? My blue line is now crossed above my purple line. You might not be able to see it that easy, but I'm telling you, the blue line crossed above the purple line right here. So that's what we're saying would be the buy signal. What then would be the sell signal? What would then be the sell signal? Blue crosses below the purple line. So here we go, here we go, here we go. Right here on this candle, actually, right here, my blue line is crossed below my purple line. So you're telling me this would be our sell signal, correct? Okay, so if we bought long on the Wednesday at 83 bucks, and here we are on Friday selling at 84.75. Is that telling us that it gave a winning trade? Could we have made money on a trade there? Because I can tell you, there's no system out there that will consistently tell you the absolute low and the absolute high. Now, let me ask you this. Are you sure you want to sell here, even though this is a higher high than this one, and this is still a higher low than this one? Well, I ask you because there's a lot of times I talk to people and they'll sell me something like, hey, I bought this because the MACD told me to buy it. And then I say, well, right over here, the MACD told you to sell it. Why didn't you sell it? Well, I thought it could still go up. And then they'll go into a whole bit of hoopla on why they think it could still go up. You know, if I ran my Fibonacci's here, you know, it's telling me it's kind of could still come down to here. And then they'll get that bright idea saying, you know, and if I ran like a trend line across here and then parallel that as like a channel, it's still holding that. And, you know, still, if I mark my Fibonacci retracements from the whole move, it hasn't retraced half of that yet. And then I was looking at some other indicator and it didn't say sell yet. And then they get really confused when I say, why did you buy? And you know what answer they give me? It usually sounds like this. Well, I already told you I bought because my MACD said to buy. And that's about the time they get really, really confused. So your MACD said buy here, or to sell here, sorry. Was this the absolute highest sell price you could have got? Well, no, that would have been here, so far at least. And we don't know what the future holds. So you sell at the close of this candle because the system tells you to, and because you don't want it to do what? You don't want it to keep going down when you're on calls or long in the comments. Okay, so far it looks like that was a good decision, right? So far it's actually looking like that might not have been a bad decision. Also, when we talk about where a sell was for a long position, yes, Trini, to answer your question, that would also be like a buy for puts or the start of a short position. And right here, the blue line and the purple line actually have the same value. What would that mean? They're literally, they haven't crossed, they're together. What would that tell you? Yeah, if you're short, still hold your short. If you're waiting to go long, wait to go long. Now, for me personally, when I look at this system in general, I look at something very, very simple. You know, everybody's always trying to tweak things and reevaluate things in a way that better benefits them. And one thing that I looked, and I actually traded with this for a very long time. And one thing that I looked at with trying to kind of modify things was I would always only buy a long position, not just when the 5 crossed above the 9, but the 9 had to be not pointing down. I didn't say it had to be pointing up, did I? The 9 could be flat, but the 9 could not be what? I won't go long even if the 5 crosses that 9, if the 9 is doing what? Pointing down. The reason I say that is even though the 5 is going to give you a quicker reaction because it's based on 5 candles instead of 9 candles. There's also a chance your quick reaction might be like a dead cat bounce or just a short little bounce that has had no bearing even on an overall down move. So if I'm going to go long, I'm not going to go long unless that 9 is not pointing down, which means if I'm going to go short, I would not go short if the 9 is pointing where? Pointing up. Now, there'll be very few instances where you actually see that happen. But there may be some instances that happen more frequently that are very similar to it, and it would come from using a sell signal the exact same way. So let's say I go to buy, my 9 moving average has gone flat or maybe pointing up, and my 5 crosses above it. That's what we discussed as being a buy signal, correct? Well, you see, the last 5 days could have been like days like this where it's like up, 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 but the 9 maybe didn't register yet. It was only flat. And then the next day I have a down day. And I might have a down day that still above where I got my entry with the 5 crossing the 9. But because the 9 never started curling up, this 9 day or this one red candle sometimes will cause that 9 to do what if it hasn't started curling up yet? It's only flat, hasn't gone anything but flat, and now we're falling again. What could happen? The 9 would be pointing down. Well, for me to be long in it, I need the 9 to not be pointing what direction? Down. So you'll see that very few times. But if you see your buy signal, 5 crosses above 9, your 9 is not pointing down, so you go long, and then all of a sudden your 9 starts pointing down, that would mean it doesn't qualify as a buy anymore, right? Which would mean it would no longer qualify for you to have bought it. Does that make sense? And if it no longer qualifies for you to have bought it, what should you do if you did buy it? Sell the position. Where I have found that most frequently is in a time where I feel like the stock might be at a bottom. Maybe it's fallen like something like this, but it consolidated a little bit more. My 9's gone flat, my 5 was flat a little bit longer, and one green candle pops up and my 5 crosses it, and my 9's not down. So I make the buy. And I might get another day out of it, my 9's still a little bit flat. And then I get this red day, and I could sit and say, well, shoot, if I waited for the 5 to cross below the 9, it could go down a lot more. But what I found is when that 9 continues in a direction, if I just get out of it, my overall profits, not profits for one trade, my overall profits for a trading system on a particular stock do better. Now, let's real quick just kind of take a look at how it reacts on a 15-minute chart. And for this, I'm going to change the time scale on it a little bit. I'm still going to do 15 minutes, but I'm going to do this so I can zoom it. And we're going to go back. Let's just start random area right here. This candle right here, you've got your 5 crossed above your 9. And your 9's not pointing down. They're exponential moving averages. One of the few times you'll ever hear me talk about EMAs instead of SMAs. Which would have actually given you the signal to buy calls, right? Right here. Buying calls. 5 crossed above the 9, and 9 is not pointing down. Look right here what happens. Do you see what happened on this candle? What happened here, even though the 5 did not cross below the 9? The 9 pointed down. You're going to say, but yeah, look at the very next candle. It's a green one. Let's keep looking at those candles. Because when the 5 actually did cross the 9, it was right here. Which one would have been the better sell? Here or here? It's almost like the 9 likes to give you little hints, just like right back here. Your 9 started pointing down on this candle. The 5 didn't cross it until this candle. Youch. Then on this bounce, it goes right back up to where? Where the 9 started pointing down. This would have been the difference between, sadly, this would have basically been a break even, maybe even a small loss. It would have been the same day. It'd have been about a 3-hour long trade. You get a pop, drop, get the sell signal. It's pretty much right where you bought it at. But it's a lot better than this, isn't it? It's a lot better than ignoring your sell indication. Here we could have been in puts, still puts. Oh, that's nice. I want you to look at something. And it's actually, oops, not on that one. This is still all on puts play. Right here. What happened to your 9 SMA here? Look at it. It's not flat there. It turned up. So this could have had you in a puts position from right here. Sorry, right here. 85.90 to the close of this candle at 80.92. But the 5 did not cross above the 9 yet, did it? The 5 did not yet cross above the 9. As a matter of fact, it still hasn't here, or here, or here, or here. But the 9's doing something different here. What's it doing different? Curled up here, started going flat here, pointing down. Now, the 5 did not just cross below the 9, but it is crossed below the 9, right? Now, in this particular case, you would have been coming off this nice win on the puts that you could have bought right here. Boom, 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 boom. sold them. Looks like it's setting up again. This thing might do well. And actually, I'm sorry, it's already bleeding off and showing me the next candle. Both of them are flat here. It's actually the next candle that we need to look at. And here, actually, no, I'm wrong. It was this one. I had to look at the value on it. It did go down. So here we would have taken puts. Right here, you're probably happy you took puts. But I want you to look, again, what happened right here? Look at it. So what would we have done with our puts? The 9 is no longer pointing down or sideways. It's pointing up, but my 5 hasn't crossed it yet. We sell. Do we need to buy calls here? We'd still wait. Now, once again, by using that simple 9's got to not be pointing up if we're in puts, kind of helps you out. Now here you get the 5 SMA cross. What would you do on this candle here? 9 EMA cross. Sorry, I said SMA, I meant EMA. What would you do here? Buy calls. That gap down there, does that give you reason to sell your calls? Might suck to look at, right? It definitely might suck to look at. What happens here? My 5 hasn't crossed it yet, though. But if I wait for it to cross it, still hasn't crossed, still hasn't crossed. There, it crossed it. You see the little bit of importance, and to be long, the 9 cannot be pointing down, and to be short, the 9 cannot be pointing up. Could have been in puts over here. Here, the 9 crosses up, or moves up, but the 5 has not crossed it. What would we want to do right here? Sell our puts, right? Gave you a puts buy right here. And there's your cross. See, if you waited for the cross, you turned what was actually just a wee little win in here, out like 45 cents later, but in the same day. Could have been some money made there. But you took that little win and turned it into what? Yeah, a loss. No, not at all, James. The buys come on the 5 crossing the 7, or sorry, the 9. And the qualifier we have to have is if I'm going to be in calls, the 9 cannot point down. And if I'm going to be in puts, the 9 cannot point up. Does that make sense? Because sometimes they'll curl without crossing. By the way, here we would have taken some calls. Look at your 9. From here to here, what did it do? I'm not even saying it did it on this candle at the high. It did it on this candle right here. It pointed down. What would we do with calls if the 9 is pointed down? You'd sell it. But it didn't tell you to buy puts till right here. Right? This is where the 5 crossed below the 9. Luckily, it told you to sell 40 cents higher. Here we'd be in puts. Do you notice what happens here? What happens here? Yes, it's being recorded. Look at your 9. For some odd reason, probably because it started factoring in this big candle and this candle, I got my 5 or my 9 at a higher value than the candle before. But my 5 didn't cross. Now you're going to say, well, okay, that's good right here that it told you to get out. But actually what happens, it turns right back around and points down here, which would have had you buy again basically at the same price you sold. But it also didn't have you risking for it to continue upwards. That's the big difference there. It actually gave you a little signal before that popped. Here, the 9 is actually still flat. So it wouldn't have saved you there. And there it's pointing down. Nine's flat. It's actually down still, down. See what the 9 just did here? And it wasn't until here. The 5 actually crossed here, so this could have suckered you into some calls. But it got you out of your puts. And then sadly, you wouldn't have been in any puts here. And there you would have grabbed calls. Right here, you would have sold calls because the 9 actually decreases its value. And it ended the day as such with actually the 9 curling back upwards. But using this particular ideology for the trading, what it can do is give you, sometimes people don't understand where to put a swing point. Sometimes people don't understand where to put Fibonacci extensions. Sometimes they don't understand where to put Fibonacci retracements. Maybe they don't understand where to put a trend line. Different from the actual indicator, which also factors in volume, reaction to volume, depending on the indicator, a whole bunch of different things. The moving averages factor in one thing, and what is that one thing? It's the only actual thing that's important to most of us. Price. It excludes the craziness of volume, reaction to volume. There's some indicators that actually will factor in a correlation between that stock and other stocks in its sector. Some of them that'll do between that stock and the S&P 500, and it's all part of proprietary algorithms. Sometimes they're so proprietary that you have no clue what's actually factoring that indicator. But you know a moving average is factored on what? Price and price alone. Now, an exponential moving average is factored slightly different than a simple moving average, but the algorithms included are still factoring price. It's just instead of the closing price, there's a slightly different algorithm to how it factors price. But price is the only item that goes into it. And essentially, you get to trade it like trading a MACD. And using the exponential moving averages of 5 and 9 are what I have found can easily translate to any chart, any time frame chart. I could put it on a 5-minute chart. I get the cross here, 9 curled down here. This one wouldn't have been too good of one. Here, I go here, 9 curled down here. There would have been a winner. I could have taken some puts here, 9 curled up here, even though I didn't get the cross, gotten out of my puts and bought calls right here on the cross. It's very efficient on a 30-minute chart. In fact, the 30-minute chart you will find is where you will have the most efficiency. Why? I'm not going to act like I know that. But I know when trading it on a 30-minute chart, it's been quite efficient, as opposed, not to say that the 15 and the 60 aren't, but the 30 gives you less choppiness than a 15, right? Because each candle takes twice as long to close. But it gives you a quicker reaction than the 60 because it takes less time to close. I like to keep it simple with how I trade and what my systems are. And that's easy for me to understand. I don't want choppy because in a perfect world, I'd like to buy and whatever I buy go up in value without choppiness and mixed signals. But I also don't always want to wait forever for the efficiency and clarity of a 60-minute chart. for shorter term trading, it'd be one I don't even have a setting for here, but the 10-minute chart. So where for a lot of my trading systems, I talked to you about how I like to use the 15, the 60, the daily. For this particular system, there is more efficiency in a 10 and a 30 than there is a 15 and a 60. What does that mean to you? How should you take that statement that I just made? It would mean that if you were using this particular trading system, and maybe you see me with 15-minute and 60-minute charts and talking about those, but you are following your buy and sell signals, you would want to do it with a 10 and 30 and maybe not listen to what I might be saying about my 15 and my 60, right? Because the most important coefficient to a trading system is its efficiency. And if it's more efficient on a 10-minute and a 30-minute than it is a 15 and a 60-minute, then you would want to use it on a 10 and a 30 and not a 15 and a 60. There are going to be differences, aren't there? I might be in the chat room one time saying, oh, I'm waiting 15-minute close below this. If you're using this type of trading system, are you waiting on a 15-minute close below a certain point? No. As a matter of fact, does a price even matter? Does the actual price even matter? No, there is no specific price that it has to close above or below. It's just got to do enough to make one line cross the other, right? So I might say, okay, guys, on BABA, I'm waiting for a close below 82.67 on my 15-minute chart, and you're saying, it just told me to buy calls, right? That's what it told you. It just told me to buy calls. Or I might say I need a 15-minute close. Okay, guys, I'm watching BABA for my 50-50 system. I need to see a 15-minute close above 82.57 right over here. It's about during this candle, blah, blah, blah. It's about 12:30. We watched the candle open about 12:40, 12:45.
and you're saying, dude, I don't know what you're waiting on to buy calls there. I bought them right here at 11 o'clock. My candle closed. I got my 5 crossed above my 9. My 9 was not pointing down. And it hasn't. Well, actually, it did point down right here. So I got out of those at 3 o'clock, maybe 3:10. Now, in the case of one particular trade, does that mean that trading system is always going to be better than the one I choose? No. But on this chart, what are you not required to do that I'm required to do on my charts? Yeah. Well, you don't know where your indicator is going to end up until the candle closes, Rolf. There's a bunch of times that while the candle's open, it looks like it's doing something and it doesn't finish doing that. You still want to wait for your time frame to close. That's your verification that, yep, it crossed. You're still going to wait for a candle to close. But you're not necessarily waiting for, well, let's put it this way. On the 15 right here, okay, I had this 10-15 candle, 81.78 was the close, 50-50 system. I got to get a close of a 15-minute candle above that, right? Which means I couldn't buy calls until this candle closed at 82.24. And in this particular case, it had nothing to do with what the closing price was on this, so long as at the close of the candle, the blue line crossed the purple line. That's it. You got to wait for the close to know that that's what your indicator's doing. I mean, look at a daily chart during the day with a MACD on it and tell me how many times that MACD wiggles and does not correlate with where it closes that day at. It'll do it with almost every penny tick. You'll get a little wiggle on it. But where I was waiting for a specific candle to close above, and I couldn't even buy it really till this candle closed, this system would have actually had you buying calls right here. The big difference in this and the way that I trade, for let's even say this particular stock, BABA, weigh the pros and cons of the two. The pros of this system, I don't have to draw on my chart. Okay. What other pros would there be? Just compared to the 50-50 system on a 15-minute chart. One pro is I don't have to draw on my chart. I gave you one. Give me another one. Yeah, only in one position at a time. You don't have to set up 2 cells. You're also not limited to only a 50% profit on your first sell, right? Now we'll talk about the cons. Anybody that trades the 50-50 system for any amount of time, not just a couple days, will actually say it's a con that you're only in one position at a time. What would the other con be compared to the 50-50 system? You have to watch it and you have to sell it. What's the hardest thing for a trader to do? Hardest thing for a trader to do. Sell. So that would be a con, right? Because we can talk right now at 9 o'clock at night and say you sell if 5 crosses below 9, right? Or if 9 points down, you would sell calls. Does that mean you'll do it when you see it in real time? Or what if you have a lunch date? Oh, shoot, I got to leave for lunch. If you got to leave for lunch, what do you got to do? If you need to go to the bathroom, what do you need to do? Sell it. As a matter of fact, you can't even take your eyes off of it, right? Quite literally, I mean, for 10 minutes you can, because you got to wait for a candle to close. But you got to focus on your one position. Okay, going up, 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 up. Okay, we're good, we're good. Which means you can't do what? You can't watch other stuff, but you also, I mean, you can't even really. I'll tell you, for me, the biggest pro with the 50-50 system, even though I can make better profits on just some single direction trades, they're single trades. I make a buy and I wait to sell it, and I just watch that and wait to sell it. The 50-50 system, if I'm going to get a nice quality move, am I only going to have one position in it? And if I have to leave, do I have to sell it? No, because in reality, as soon as I bought a 50-50 trade, it's already sold, isn't it? Very good, Michael C. As soon as I bought it, it's already sold because I put my sell orders in. So who's confused now? Hold on a second. This looked pretty good because one time it gave me a better buy that I didn't have to wait on the 50-50 system. But now you're starting to say you like some other things about the 50-50 system. Well, I'm going to tell you, to each their own. If it is confusing for you to draw on a chart, if you can't think like I try to preach with the 50-50 system of don't look at your account page, make all the qualified buys, and you're like constantly worried about all the positions you're in, what do I do with that one, and crap, I keep missing buys because I'm wondering about other stuff I got, then the 50-50 system might not be for you. This would be a single buy and a single sell. And if you had time to sit and watch it, you could easily trade it, couldn't you? Can it still be an effective trading system? Absolutely. I wouldn't talk about it if it could not be an effective trading system. See, people that think like that have never once listened to a word I've ever said. So if you are interested, or if you're confused with drawing on charts, if you're confused or maybe don't like the 50-50 system, maybe you don't want to trade Fibonacci's because you got to draw on stuff and you don't even know where to even start. You don't have to do that with this, do you? This is a trading system for chart watchers. It's a trading system for chart watchers. And for a lot of new traders, chart watching might be your best bet, because if you simplify it, I mean, you notice there's not a whole bunch of crap on this chart, right? I don't have a whole bunch of crazy crap. I've just got two little lines. You're still going to be best, in my personal belief, on any trading system, waiting for a candle to close to confirm something, whether it be the break of resistance, the failure of support, or something with your indicator. That's a good question, Stephen. If you guys remember, over the past few weeks, I've talked about different ways to pick your strikes and your expirations. And one thing I stayed pretty consistent with when we started our first technical series of this, or technical lesson of this series, is I said, if you're going to trade on any indicator, you should trade what type of options as far as the relation to the strike price. I don't care if you're trading an RSI. I don't care if you're trading a MACD. I don't care what indicator it is. In or at the money. In or at the money. Now you could say, yeah, but if I went like 3 strikes out of the money on something, you know, on this one, it would have done pretty good. See, that's the big problem a lot of traders have, is because they think about this one and not maybe one that gave you a cross but stopped you out. And if you trade the at or in the money, when I say at the money, is if it gave you a buy signal right at 82 bucks, the 82 call is the at the money call. But if it gave you a buy signal at 81.25, the 82 call is at or out of the money. So one that's either already in the money or right at the money will actually give you a little more protection to the downside, because unlike something like a swing point trading system, a channel trading system, a Fibonacci trading system that gives you a physical price to stop out at, right? If I'm trading Fibonacci's, I've got like a 0 line that says, don't let it go above or below that price, right? It gives me a physical price and a price target point. This would take some time to give you a sell signal. It won't just instantly say, crap, sell it. Very rarely would it. And that time aspect, in correlation with what it could also do to the other side, is why you would want to be in or at the money. Now on this one, we're talking about moving averages. Do you come in, and we'll just use today, here's today's start right down here. Do you come in at 110 and say, hey, blue line's above the purple line, I'm gonna buy calls? When do you have to buy it? When the buy signal is given. Otherwise, what you're going to have is your wins will be smaller when you're chasing in the middle of the trade, and your losses will actually be bigger. So just like any moving average or any particular indicator, you've got a very small window. I don't have that window with the 50-50 system, right? Right there, boom. That's this candle, that's your buy. Are there any other buys using this system on this chart? are there any other buys? And I'm not talking about, well, if I would have done it this one time, if I'd have bought right here and sold right here, I could have made some money. I'm not talking about people that focus so much on what ifs and crazy aspects that they end up losing all their money before any of the harebrained ideas they thought of actually worked out. I'm not talking about those people. I'm talking about when you worry about the risk side. What if I get in it and it does curl around? Look how far off the curl I am. The smart buy for me was right here. And as I continue upwards, or like in this case, how many puts buys did it actually give you using this system? Where's the second one at? I'm lost. The 5 crossed below the 9 here. Yeah, I guess, this candle could have had you buying puts. You just stopped out of it on this candle right here. That's where you would have stopped out on your puts. That would have been a loss. So what do you think the most important factor of this style of trading system is? And I can tell you, if you'd have been in that puts trade, you wouldn't have mind losing on this one. The most important factor is being ready when the signal's given, right? Wouldn't that be the most important factor? So if I'm on a 10-minute chart, do I know exactly which 10-minute candle is going to give me the buy signal? I mean, can I actually say, hey, boss, I need to leave at 10:15 because my stock is going to tell me to buy it right at 10:15. And then I'll have to leave again at 2:37 because that's when I have to sell it. So if you're going to commit to trading this particular system, what do you have to do? Not only do we have that con of I've got to stare at it until I sell it, I got to stare at it until I buy it. Right? Well, then you're getting into what ifs and changing a fairly easy to follow trading system. Okay, keep it simple. You can get a lot of good trades using this trading system. And I would kind of use the same type of rules that you would use on the 50-50 system when it comes to Friday. With the 50-50 system, what do we do on Friday? We move to next week's options. And if you're trading on a 10-minute, you could trade the current week's expirations until Friday, where you would want to go out to the next week's. Because you're going to be trading something in or at the money, is time decay going to affect you much? Do you think time decay would have hurt you on this trade? This one from Friday, where you would have bought this week's expiration and sold them really yesterday afternoon? Would time decay have affected you much? The fact that you would have been buying 85.50 puts for this week, and actually your 9 curled up right here at 82.03. I'll say it like this. There would have actually been an effect, but you wouldn't have noticed it. And if you don't notice it, it's easy to say there's not an effect. So when you do the 10-minute chart, trading at or in the money for the current week until Friday, in which time you can move it out to the following week. If you're doing it on the 30-minute chart, trade next week's expiration until Friday, and then you move it out to the following week, and still be at or in the money. And the main reason to do that is not so you don't get as much volatility if it moves $5-6 downwards. It's actually because of the time it could take to curl the other way before it gives you a sell signal. Trading too far out of the money, if you'd have been early, in this case, it didn't give you a buy signal for calls right here. But if you'd have tried to jump the gun, bought calls like right here, and you just said, okay, I'm going to trade like the 85 calls. By the time it actually said, hey, ding dong, this isn't a calls play, you've taken a much larger loss by trading out of the money than by trading at or in the money. Don't quite know what you're meaning there, Michael. But again, this type of trading system is really good for somebody that struggles with marking charts and understanding what those marks are. It is a good system for chart watchers. And I refer to it, and I always have, as the MACD moving averages. I was taught a system similar to this with different values for the moving averages. And it was always referred to as the MACD moving averages. And it's just easy for me to remember that way.